Imagine if you could unlock hidden opportunities to keep significantly more of your hard-earned money each year. I mean, what if understanding just a few core tax concepts could fundamentally change your financial outlook, allow you to optimize your situation and, well, truly take control?
It's really not about complex loopholes or, obscure strategies. It's more about mastering the foundational rules that apply to almost everyone. And once you do that, the clarity you gain and the potential for smart financial moves, it's truly empowering.
Welcome to the deep dive. Today we're plunging headfirst into your stack of material on individual income tax. Specifically, the core mechanics that dictate how your income is taxed, who needs to file,
Right.
and perhaps most crucially, how your filing status and dependence can significantly shift your tax landscape. This often reveals major opportunities for, financial optimization.
Yeah, our mission today is pretty simple: to transform what might seem like daunting tax jargon into clear, actionable insights. We want to show you why these details don't just matter, but how mastering them can actually lead to substantial year-round savings for you.
Okay, let's pull back the curtain on this a bit. When we talk about individual income tax, it all kind of funnels down into one fundamental formula. This determines your tax liability or your refund.
Mhm.
Think of it as the ultimate financial roadmap. I mean, it's literally the blueprint for your Form 1040. It's the grand equation every single taxpayer navigates each year, whether they realize it or not. Understanding its flow is really the first step in truly understanding your financial picture.
And what's truly fascinating here, I think, is that this formula provides a structured, logical way to view every single dollar you earn. And, every deduction or credit you might qualify for. By breaking it down, you can see exactly where your money goes, where your tax burden originates, and, maybe most importantly, where you might strategically optimize your financial situation using legitimate, powerful tax strategies. It literally lays bare the entire process.
Yeah, empowering you to identify those key leverage points.
Exactly.
And it begins with what the IRS calls gross income. This is essentially all your income from whatever source before any reductions.
Hmm.
Think of it as the big pool of money you start with.
Hmm. The starting point.
Then, from that, we begin to kind of chip away by subtracting adjustments. These are often called above-the-line deductions, and they're incredibly powerful because they lead us directly to your adjusted gross income, or AGI.
That's right. And AGI is such a critical stepping stone, almost like your net income before you get to personal deductions. It's so important because, while many other tax benefits and limitations are tied directly to this AGI figure.
Ah, okay.
So from AGI, you then subtract either the standard deduction or itemized deductions. You get to pick whichever one is higher for your specific situation.
Right, the better deal for you.
Exactly. And that choice determines your taxable income before the qualified business income QBI deduction.
Okay, and if you happen to qualify for it, which is, often for business owners or freelancers,
Right, specific roles there.
you then subtract the QBI deduction. And that brings us to your final taxable income. This is the number that the IRS actually applies the tax rates to.
Mm-hmm. That's the key number.
So once your federal income tax is calculated on that taxable income, we then get to subtract any tax credits. Now, these are the real gems.
Oh, yeah. Credits are gold.
They're dollar-for-dollar reductions of your actual tax bill. So they're incredibly valuable for financial optimization. Much better than a deduction, usually.
Definitely. Following that, you might have other taxes added back in.
Hmm.
Things like self-employment taxes if you're a freelancer or small business owner. That's a common one.
Right. Got to account for those FICA taxes.
Exactly. And finally, we account for payments you've already made throughout the year, like payroll withholding from your job, or maybe estimated tax payments if you have other income sources.
Okay.
The result of this entire journey, this whole calculation, is your final tax due or refund. It's quite a comprehensive flow, isn't it?
It really is. So what does this entire equation mean for you, the listener? Well, every single line item isn't just a number on a form. It's a decision point. It's a potential opportunity for significant tax savings.
Hmm.
Think of gross income as your starting pool. Adjustments and deductions, they're like powerful filters, reducing the amount of that income the government can even consider taxing.
Right, shrimping the taxable base.
And credits, those are direct discounts on your final tax bill.
Yeah.
Understanding each of these components empowers you to actively engage with your financial picture, rather than just, passively accepting whatever tax outcome comes your way.
Absolutely. It transforms tax season from maybe a dreaded chore into a real strategic opportunity. This comprehensive formula is truly the blueprint for financial optimization. Yeah.
Every smart tax move, every conversation about maximizing your return, it stems from understanding these individual components and their sequential impact. It's about recognizing that each step is a potential point of leverage, a chance to keep more of your hard-earned money.
That brings us to a crucial point then. What precisely makes up your gross income? Because you said it's the starting point.
Yeah.
It's broader than just your regular paycheck, right? Understanding the full scope is absolutely crucial for accurate tax planning.
Oh, definitely. Many people just think of their W-2 from their job, but the IRS casts a much wider net.
Okay.
When we talk about gross income, we're talking about almost all income from whatever source unless it's specifically excluded by law. So it includes, of course, your wages from a traditional job,
Yep. The main one for most people.
but also any interest you earn
Right.
from savings accounts, bonds, other investments. Did you know that even a few dollars of interest from your bank account counts?
Really? Even tiny amounts.
Yep. It might seem small, but technically it all adds up. It's income. Huh. Okay. And then there are dividends payments you get from owning shares in companies.
Right.
Hmm.
Or this one's interesting. If your state gave you a refund on your state income taxes from a prior year, that state tax refund might be included in your gross income. It depends on whether you itemized deductions in that previous year.
Okay, a bit tricky. Then there's alimony you received, but you mentioned a specific rule here.
Yes, a very important cutoff. It only applies to alimony payments from divorce or separation agreements executed on or before December 31st, 2018. If your agreement is newer than that, alimony received is generally not considered taxable income for you, the recipient. Big change there.
Got it. Good to know.
Beyond that, if you're entrepreneurial, any business income you generate from a sole proprietorship, a side gig, even selling crafts online that's part of your gross income, the IRS expects to see that reported.
Right. Even if it feels like a hobby sometimes.
Well, there are rules about hobby versus business, but generally, income is income. And for investors, capital gain or loss from selling stocks, real estate, or other assets at a profit or a loss contributes to this figure too.
So it's not just your regular earnings, but investment gains too. Makes sense.
Your retirement income also plays a significant role. That includes IRA income from distributions you take,
No.
and pension and annuity payments you receive once you're retired. If you own property and rent it out, that's rental income or loss.
Landlords need to track that carefully.
Absolutely. And for those involved in partnerships or S corporations, you'll see something called K-1 flow-through income or loss. This isn't a salary, it's your share of the business's profits or losses that flows through directly to your personal tax return.
Even if you don't actually take the cash out of the business.
Exactly. Even if you don't take a distribution, if your small business had a great year on paper, that profit is already adding to your gross income even before it hits your personal bank account. That catches some people off guard.
Wow, okay. That's important for business owners.
And in tougher times, unemployment compensation is also considered taxable income that often surprises people, too.
Yeah, I've heard that.
Even certain levels of Social Security benefits can be included, depending on your total income from all other sources. And then there's the catch-all category, other income.
The miscellaneous bucket.
Pretty much covers anything not specifically listed but generally taxable, like gambling winnings, awards, maybe prize money. So as you can see, it's a really comprehensive picture of all economic inflows. It's critical not to overlook any of these sources when you're figuring out that starting point.
Okay, so that's gross income. Now, you mentioned adjustments. This is where it gets really interesting for your bottom line, right? These adjustments are golden.
They really are. They're golden because they reduce your adjusted gross income, or AGI, directly. And crucially, regardless of whether you itemize or take the standard deduction later on. They're often referred to as above-the-line deductions precisely because they come off before you even calculate AGI, before you consider those other major deductions.
Which makes them incredibly powerful for financial optimization, accessible to many taxpayers, not just those with huge itemized deductions.
Exactly. If we connect this to the bigger picture, these adjustments are often some of the most straightforward and universally beneficial tax strategies available. And this is critical because, remember, your AGI can impact your eligibility for many other tax credits and deductions that have AGI phase-out limits.
Right, so lowering your AGI here can actually unlock more savings later in the calculation.
Precisely. It can create this positive ripple effect of savings. Think of these adjustments as your frontline defense against a higher tax bill.
Okay, so what are some common examples? You mentioned teachers.
Yeah, if you're a K-12 educator, certain educator expenses for things you buy for the classroom books, supplies, maybe professional development up to a certain limit can be deducted.
Nice. What else?
Contributions to a traditional IRA are a big one for many people. Allows you to reduce your taxable income just by saving for retirement. A really powerful incentive.
And student loan interest paid.
Is
That's
the-
an adjustment too.
Yep, up to a certain amount. That can provide a significant reduction for those diligently paying off their education loans.
Okay. What about health stuff?
Well, if you have a high deductible health plan, your health savings account, HSA contributions, are also an adjustment. And HSAs are particularly powerful.
Why is that?
They offer a triple tax advantage, tax-deductible contributions, tax-free growth inside the account, and tax-free withdrawals for qualified medical expenses. It's hard to beat.
Wow, okay. HSA contributions, good to know. Any others?
For members of the armed forces, certain moving expenses incurred due to military orders can be deducted. It's a very specific carve-out just for military families.
Gotcha. What about people who work for themselves?
Ah, yes. Several key ones for the self-employed. You can deduct 1/2 of your self-employment taxes as an adjustment. That helps offset some of that Social Security and Medicare burden.
Okay, that's helpful.
Similarly, if you pay for your own health insurance because you're self-employed, those premiums for self-employed health insurance are generally deductible as an adjustment.
Another big one, potentially.
Definitely. And if you're contributing to a retirement plan as a self-employed individual, like a SEP IRA or a solo 401k, those self-employed retirement contributions are also fantastic adjustments. Again, saving for retirement reduces your current tax bill.
Great incentives. Any left common ones?
Well, if you've ever had to withdraw money from a certificate of deposit, a CD, early and paid a penalty, that interest withdrawal penalty is an adjustment. And mirroring the income side, alimony paid is an adjustment.
But only for those older agreements, right?
Exactly. Only for divorce or separation agreements executed on or before December 31st, 2018. Same cutoff applies.
Okay.
The key takeaway here, I think, is to proactively look for these adjustments throughout the year. Don't just wait until tax time. Maximize your contributions to traditional IRAs or HSAs, for instance, to realize these immediate AGI reductions.
And potentially unlock other benefits later.
Right. These are often the easiest and most impactful ways for many people to reduce their taxable income.
Okay, so once we've navigated gross income and taken out those adjustments, we land on AGI. And you said then you face a crucial fork in the road.
That's right. The choice between the standard deduction or itemized deductions.
Which one is best for you? I guess the goal here, like with a lot of tax stuff, is to choose the path that maximizes your deduction, right?
Yeah.
Minimizes your taxable income further.
Exactly. You simply take whichever amount is higher. For many, many taxpayers, the standard deduction is the simpler and often more advantageous choice, especially after the Tax Cuts and Jobs Act significantly increased its value a few years ago.
So most people just take the standard now.
Yeah, something like 90% of taxpayers now take the standard deduction. It's just easier and often bigger. However, if your specific expenses are high enough, itemizing can still lead to greater tax savings. It's really about knowing your options and doing a quick comparison.
Okay, so what kind of expenses could potentially let you itemize? What qualifies?
Well, one common one people think of is medical expenses, but there's a pretty high bar here. They must be in excess of 7.5% of your adjusted gross income.
7.5% of AGI. So if your AGI is, say, $50,000.
Right. You could only deduct the medical expenses above $3,750. So you need quite significant medical bills before you get any benefit from this deduction. It usually requires a major health event or ongoing chronic condition.
Okay, so that's tough for many. What else?
Another significant itemized deduction is for state and local taxes, often called SALT. This includes property taxes on your home and either your state and local income taxes or your state and local sales taxes. You choose which one of those is higher.
But there's a catch now, isn't there?
Yes, a big one. The total SALT deduction is capped at $10,000 per household per year, $5,000 if married filing separately. This limitation has a noticeable impact on taxpayers in states with high income or property taxes.
Right, that cap really changed things.
Mm.
Okay, what else can be itemized?
There's interest expense. This primarily covers home mortgage interest on loans used to buy, build, or substantially improve your main home or a second home, subject to certain loan limits. There's also sometimes investment interest expense, but that's more complex.
So mortgage interest is a big one for homeowners who itemize.
It often is, yes. And for those who are charitably inclined, charitable contributions are deductible.
Okay. Any limits there?
Yes, there are AGI limits. They vary by the type of donation cash versus
Mhm.
property like stocks and the type of organization you're donating to, like a public charity versus a private foundation. For cash contributions to public charities, you can generally deduct up to 60% of your AGI.
So you can't just deduct everything if you give away a huge chunk of your income.
Not usually in one year, no. But there are carryover rules that let you claim excess contributions in future years, which is helpful.
Okay. Any other major itemized deductions?
Well, there used to be more, but they've been restricted. Casualty and theft losses are now highly restricted. They generally only apply if the loss is attributable to a federally declared disaster area. And even then, it's only the amount that exceeds a $100 floor per casualty and 10% of your AGI in total.
Wow, so unless you're in a major disaster zone, that's unlikely to
It's
apply.
very unlikely now, yes.
So looking at that list, medical over 7.5% AGI, SALT capped at $10, mortgage interest, charity.
This raises an important question for you, the listener. Are you meticulously tracking enough of these potential itemized deductions throughout the year?
Good point.
Many people miss out simply because they don't know what qualifies or they just don't keep detailed records. Even if you usually take the standard deduction, understanding what could be itemized helps you recognize if you have a year with, say, significant medical bills, or you make a major charitable donation, or maybe you buy a home and suddenly have mortgage
Right,
interest.
circumstances change.
Exactly. Those changes might push you over the standard deduction threshold for that year. Proactive record keeping is a clear financial optimization strategy here. It ensures you don't leave money on the table just because you weren't prepared.
Absolutely. Keep those receipts, track those donations. Okay, so we've gone through the formula down to taxable income. But before we even start that, there's a fundamental question. Do you even need to file a tax return?
Yes, that's the absolute first step. It's not just about earning income. There are specific thresholds. And surprisingly, not everyone is required to file.
Okay, so how do you know? What's the general rule?
Generally, you must file a return if your gross income, that starting number we talked about, is equal to or greater than the sum of two things.
Okay.
First, the regular standard deduction amount for your specific filing status. Single, married filing jointly, head of household, they all have different standard deduction amounts. There's an exception for married filing separately. Their threshold is much lower.
Okay, so your standard deduction amount plus what?
Plus, any additional standard deduction amount you might get if you're age 65 or older, or if you're legally blind. Again, there's an exception for married persons filing separately.
So basically, if your gross income crosses that line, your standard deduction plus any age blindness bumps, the IRS expects to hear from you.
That's a good way to put it. It's their way of saying, okay, you've earned enough this year, let's talk taxes. These threshold amounts adjust slightly each year for inflation, but the principle stays the same.
That's a crucial point.
Hmm.
So for example, if you're single, under 65, and your gross income is, say, $10,000, which might be less than your standard deduction, you might not be required to file.
Correct. You might fall below the filing threshold. However, and this is really important, even if you're not legally compelled to file, it might still be beneficial for you to do so.
Why is that?
Well, think about it. If you had a job, even part-time, and your employer withheld federal income tax from your paychecks.
Ah, you might be due a refund.
Exactly. The only way to get that withheld money back is to file a return. Also, you might qualify for refundable tax credits.
Like the earned income tax credit, or
Yeah,
parts of the child tax credit.
precisely. These credits can give you money back even if you owe zero tax. But again, you have to file a return to claim them and get that refund.
So the bottom line is, always evaluate if filing could benefit you, even if you're not technically required to. Don't leave free money on the table.
Absolutely. That's a key piece of financial self-care right there.
Okay, so let's say you do need to file. When is the deadline? Everyone knows April 15th, right?
April 15th. Yes, that date is etched into the minds of many taxpayers across the U.S. It's the traditional deadline for individual taxpayers to both file their returns and pay any taxes owed.
So it's for filing and paying.
Correct. Technically, it's the 15th day of the fourth month following the close of the taxpayer's taxable year. Since most individuals use a calendar year ending December 31st, that lands on April 15th.
Unless it falls on a weekend or a holiday.
Exactly. If April 15th falls on a Saturday, Sunday, or a legal holiday like Emancipation Day in D.C., the deadline shifts to the next business day.
Okay. But what if life happens? You're missing documents, maybe there's a family emergency, you just can't get it done by April 15th. Is there any leeway?
Yes, there is. The good news is an automatic 6-month extension to file is available. This pushes the filing deadline to October 15th.
Automatic, so you don't need a reason.
Nope. No reason needed. It's granted automatically, but, and this is critical, you must request it by filing Form 4868, Application for Automatic Extension of Time to File U.S. Individual Income Tax Return. And you have to file that form by the original April 15th due date.
Okay, so you have to ask for the extension by April 15th using Form 4860, even if it's automatic once you ask.
That's correct. It's a simple form, often just takes a few minutes online or through tax software, but it's absolutely essential to submit it on time if you need the extra 6 months to get your paperwork together.
Now, you emphasized extension to file. Is there something important there?
Hugely important, and this is a very common point of confusion that can lead to trouble. Filing Form 4868 grants you an extension of time to file your return, but it is absolutely not an extension of time to pay any taxes you owe.
Ah, okay, say that again. Extension to file, not to pay.
Exactly. Even if you get that filing extension until October 15th, the due date for payment of any taxes you estimate you'll owe remains April 15th.
So if you think you're going to owe the government money, you still need to figure out roughly how much and send that payment in by April 15th, even if you're filing the actual return later.
Precisely. You need to estimate your tax liability and pay as much as you can by the April deadline to avoid penalties and interest on any underpayment. I've seen far too many people get an extension, mistakenly believe it also extends their payment deadline, and then get hit with completely avoidable penalties and interest charges.
Okay, so to be crystal clear for everyone listening, if you owe money, that April 15th payment deadline is firm. You still need to estimate and pay what you owe, even if you're extending the paperwork. It's like asking for more time to turn in your homework, but you still had to pay for the book by the original due date.
That's a good analogy. Many people forget this and end up with late payment penalties, which can add up surprisingly quickly and completely negate any potential financial optimization you were trying to achieve by filing accurately later.
Right. That would defeat the purpose.
Which raises an important question for you, the listener. Are you planning ahead for payment, even if you anticipate needing more time to gather your documents for filing?
Yeah, thinking about both deadlines separately.
Exactly. Penalties for late payment can be substantial. There's typically a failure to pay penalty, which is usually 0.5% of the unpaid taxes for each month or part of a month that the taxes remain unpaid, up to a maximum of 25%. Plus, interest accrues on the unpaid amount.
Ouch. That adds up.
It definitely can compound. Filing an extension is a smart move if you need more time to prepare an accurate return. Avoiding mistakes is good, but it does not buy you more time to pay your tax bill. Always, always aim to pay as much as you reasonably can estimate you owe by April 15th, even if you can't file your complete return by then.
Okay, that's a really critical piece of advice. Pay by April 15th, file by April 15th, or file for an extension by April 15th.
You got it. It's a proactive step that truly safeguards your finances.
All right, now let's shift gears to something that happens on the tax return itself. Your filing status. You mentioned this earlier. It's not just a label you pick on the form, is it?
Not at all. It's one of the most fundamental decisions you make. And it directly impacts your standard deduction amount, your tax brackets, meaning the rates your income is taxed at, and even your eligibility for certain credits and deductions.
So getting this right is a primary financial optimization strategy. It could save you hundreds, maybe thousands.
Easily. It determines the entire structure of how your income is taxed. So it's really worth understanding deeply which status applies to you or which might be most beneficial if you have a choice.
And what's fascinating here, I think, is how seemingly minor life changes, like getting married, becoming a parent, maybe experiencing the loss of a spouse, can open up completely different and often far more advantageous tax statuses.
Absolutely. It truly underscores the importance of reviewing your personal situation at the end of each year, because ignoring these potential shifts in filing status can actually cost you dearly if you choose a less favorable one.
Okay, so let's walk through the main options. The most straightforward one seems to be single.
Right. You are considered single for the whole year if, on the last day of your tax year, which is typically December 31st for most people, you are either unmarried or legally separated from a spouse under a divorce decree or separate maintenance decree according to your state law.
So it's based on your marital status on that specific date, December 31st.
Correct. Pretty straightforward determination.
Okay. Next up, joint returns, or married filing jointly, MFJ.
Yes. To file jointly, you generally must be considered married at the end of the tax year. This includes being legally married and living together, of course. It also includes legally recognized common law marriages in states that acknowledge them.
What about living apart?
You can still potentially file jointly if you're married and living apart, but not legally separated under a decree of divorce or separate maintenance. The key is your legal marital status at year end.
Okay. And this status has a few important scenarios, right? Like if you get married during the year,
Yes. If you get married during the year, even on December 31st,
New Year's Eve wedding.
hey, it happens. You are considered married for the entire year and can file a joint return for that whole tax year. So tying the knot late in the year still grants you the full year's potential joint filing benefits.
Good to know. What about the opposite, divorce?
If you get divorced or legally separated during the year, you cannot file jointly for that year. Your status at the end of the year dictates this. You would typically file as single or possibly head of household if you qualify.
And what if, sadly, a spouse passes away during the year?
In that situation, the surviving spouse may generally still file a joint return for the tax year in which the death occurred. This allows the surviving spouse to often take advantage of the more favorable joint rates and higher standard deduction for that specific year, which can help ease the financial burden during a very difficult time.
That makes sense. And generally speaking, filing jointly often provides lower tax rates and a higher standard deduction compared to, well, the next status.
Compared to married filing separately, MFS, yes. MFJ is often a common and powerful financial optimization strategy for married couples. While some couples might experience what's called a marriage penalty, where their combined tax is slightly higher than if they were single, many others find a marriage bonus due to those wider tax brackets and the larger joint standard deduction.
Okay, so let's talk about that other option for married couples,
Mhm.
married filing separately, MFS.
Right. A married taxpayer can choose to file a separate return even if only one spouse had income for the year. But this status, it can get a bit complex, especially depending on where you live.
How so? State laws matter here.
Absolutely. There's a big difference between separate property states and community property states.
Okay, break that down.
In a separate property state, which is most states, if spouses choose to file MFS, they must separately report their own income, their own credits, and their own deductions on their individual returns. Each spouse is responsible for their own tax stuff.
Okay, seems logical. What about community property states?
In community property states, think California, Texas, Arizona, several others, most of the income earned, and deductions and credits related to that income acquired during the marriage are considered jointly owned, basically split 50-50, even if only one spouse earned the income.
Wow. So if you file separately in one of those states, you might have to report half your spouse's income, and they report half of yours.
Essentially, yes, for community income and expenses. It significantly impacts how separate returns are prepared and can make filing separately quite complicated. You really need to understand your state's specific rules.
So given that it's often less favorable tax-wise and can be complex, when would someone actually use MFS?
Well, you're right. It often results in a higher overall tax burden for the couple. It can restrict access to certain credits and deductions, like some education credits or the earned income credit. But there are specific, often niche scenarios where it might be advantageous.
Such as,
For example, maybe one spouse has very high medical expenses. Filing separately might lower their individual AGI enough so that those medical expenses actually exceed the 7.5% threshold, whereas on a joint return with combined income, they wouldn't.
okay, strategic play based on AGI thresholds.
Right. Or sometimes it's used for liability reasons. If one spouse wants to avoid being responsible for the other's tax debts or potential errors on the return, or perhaps if one spouse is on an income-driven repayment plan for federal student loans, filing separately might result in a lower required payment based on their individual income.
Okay, so specific financial planning reasons, not always just minimizing the immediate tax bill.
Exactly. But generally, for pure tax optimization, MFS is less common and should be approached with caution. There's another key point, too. If one spouse itemizes deductions when filing separately, the other spouse must also itemize, even if their own itemized deductions are tiny and less than the standard deduction they would have otherwise gotten.
Ouch, that could force a bad outcome for one spouse.
It can. So MFS is typically a last resort or used in very specific, nuanced situations where the alternative is somehow worse. The key is understanding all these implications fully before choosing that status.
Okay, now there's another status related to losing a spouse, qualifying widow
Mhm.
with dependent child. How did that work?
This status, often just called qualifying widow or widower, can provide significant financial relief during a really difficult time. It basically allows you to maintain some of the tax benefits of filing jointly for a period after your spouse has passed away, assuming you meet the criteria.
Okay, what are the criteria?
You can potentially use this status for the 2 taxable years following the year of your spouse's death. So if your spouse passed away in, say, 2023, you could potentially use this QW status for your 2024 and 2025 tax returns.
2 years after the year of death. What else?
You must not have remarried before the end of the tax year for which you're claiming the status. If you do remarry, you then file jointly or separately with your new
Makes
spouse.
sense. And the dependent child part.
Yes, this is crucial. You must pay over half the cost of maintaining a household, which was the main home of your dependent child, for the entire taxable year. This dependent child must be your child, stepchild, or adopted child.
Does a foster child count for this status?
No, that's an important distinction. A foster child does not qualify you for qualifying widow status, even if they might be your dependent for other purposes. The household must be your home and the qualifying child's main home for the entire year. Temporary absences like school are usually okay.
Okay. And what's the big benefit of using this status?
The primary benefit is that it allows you to use the joint tax return standard deduction amount and the joint tax return tax rates. These are typically the most favorable, offering a larger deduction and wider brackets than single or even head of household.
So it provides a sort of financial cushion or continuity for those 2 years after a spouse's death.
Exactly. It's a key financial optimization strategy specifically designed to mitigate some of the financial shock during that bereavement period.
Got it. Okay, now for the last main status. Head of household. This one seems important for single parents or people supporting others.
It really is. If we connect this back to the bigger picture of tax savings, head of household status is a prime example of how understanding your family situation can directly lead to lower tax liability.
How so?
Because Hoki status gives you a larger standard deduction than the single status, and it also provides wider tax brackets than single,
Wider brackets meaning?
meaning more of your income gets taxed at the lower rates before you hit the higher tax brackets. Both the bigger deduction and the wider brackets generally result in less tax owed compared to filing as single. It's one of the most valuable filing statuses for many single parents or individuals supporting other qualifying family members, so it's definitely worth checking if you qualify.
Okay, so what are the conditions? Who qualifies for HOH?
There are 4 key conditions you generally need to meet. First, you must be unmarried, legally separated, or considered unmarried for tax purposes on the last day of the year. Being considered unmarried often applies if you're married, but lived apart from your spouse for the last 6 months of the year and meet other tests.
Okay, so not married or effectively treated as not married for tax purposes. Second,
Second, you cannot be a qualifying widow. If you meet the conditions for that status we just discussed, you generally use that one, as it's often even more beneficial.
got it. Third,
Third, you cannot be a non-resident alien at any time during the year.
okay. And the fourth one, this sounds like the tricky part.
It often is. Fourth, you must maintain as your home a household that, for more than half the taxable year, is the principal residence of a qualifying person. And maintaining a home means you paid more than half the cost of keeping up that home. Things like rent, mortgage interest, property taxes, insurance, utilities, repairs, food eaten in the home.
Okay, so you need a qualifying person living with you more than half the year, and you have to be paying most of the household costs. Who counts as a qualifying person for HOH?
This is where the details really matter. There are a few categories. First, a qualifying child. This generally includes your child, stepchild, legally adopted child, foster child placed with you, your brother or sister, step-sibling, or a descendant of any of these, like a grandchild.
And this qualifying child, they have to be your dependent.
Usually, yes, they must meet the definition of a dependent under the qualifying child rules, which we'll get into detail on shortly. And crucially for HOH, they must live with the taxpayer in that main home for more than half the year. Temporary absences like college generally don't disqualify them if their permanent home is still with you.
Okay, so qualifying child living with you more than half the year. What's the next category?
The second category is your father or mother. Now, what's unique here, and a point that often surprises people,
Yeah.
your dependent parent is not required to live with you for you to claim HOH based on supporting them.
Really? They can live elsewhere.
Yes. You can still qualify for head of household if you maintain a home that was your parent's principal residence for the entire year, and that parent qualifies as your dependent. Maintaining their home means you contributed over half the cost of its upkeep, rent, mortgage, taxes, utilities, food, etc., wherever they live, maybe their own apartment or even a nursing home.
Wow. That provides crucial flexibility for people supporting parents who live independently. That's huge.
It really is. It recognizes that support burden even without shared residency.
Okay. Any other qualifying persons?
Yes, the final category is other dependent relatives. This broadly covers your grandparents, brothers, sisters, aunts, uncles, nephews, and nieces. It also includes step-parents, parents-in-law, sisters-in-law, or brothers-in-law if they qualify as your dependent.
Okay, but unlike your parents, do these relatives have to live with you?
Yes, that's the key difference. A dependent relative in this category, other than your father or mother, must live with the taxpayer for more than half the year to qualify you for head of household status.
So, grandparents, siblings, aunts, uncles got to live with you more than half the year. What about cousins or friends?
Good question. Generally, cousins, foster parents, unless they meet the qualifying child definition, and unrelated dependents who live with you do not qualify you for head of household status, even if they are your dependent qualifying relative for other purposes. HOH has stricter relationship requirements.
Okay, that's clear. Qualifying child living with you, parent living anywhere as long as you support their home, or other specific relatives living with you.
Right. And remember those time periods. To avoid confusion, there's a simple pass key. For a qualifying widower, the dependent child must live with you for the whole year.
Whole year for QW.
For head of household, the qualifying person, child or relative, generally must live with you for more than half a year.
More than half a year for HOH. Got it. That tiny distinction in timing.
It can literally swing thousands of dollars on your tax bill depending on the filing status you qualify for. Precision here isn't just nice, it's absolutely essential for smart financial planning and optimization.
It truly emphasizes the meticulous nature of tax law, doesn't it? Where a difference of a few days in residency can change your entire tax outcome. Understanding these distinctions is paramount.
Absolutely. It's about claiming the most advantageous status that you legally qualify for, ensuring you're optimizing your tax situation to the fullest extent possible.
Okay, so we've talked about filing status, and a lot of those depend on having dependents. So let's move on to dependents themselves. Claiming the right people here can unlock significant tax benefits, right?
Oh, absolutely. From those advantageous filing statuses we just discussed, like head of household or qualifying widow, to qualifying for certain tax credits, like the child tax credit or the credit for other dependents. Claiming dependents is a powerful tool in your financial optimization arsenal. It can potentially put hundreds or even thousands of dollars back into your pocket.
So understanding the rules here is key.
Definitely. Knowledge is most valuable when you can understand it and apply it. The rules for dependents, well, they can seem complex at first glance.
Yeah, I've heard they can be tricky.
They can be, but they're designed logically to recognize the financial support you provide to family members or others who rely on you. Mastering these rules is critical for unlocking those additional tax savings.
Is there a basic requirement before we get into the details?
Yes, a key requirement across the board. For almost any dependent you claim, you must obtain and provide their Social Security number, SSN, on your tax return. This applies if they have attained the age of 1 as of the close of the tax year.
So get those SSNs early. Don't wait until tax time.
Absolutely. It's non-negotiable for most dependent-related benefits. No SSN usually means no dependent claim.
Okay. Now, the source material mentions some mnemonics, cares, and support.
Yes, those are helpful frameworks some people use to remember the tests for the two main categories of dependents. Qualifying child, cares, and qualifying relative,
Whoa.
support. We don't have to rigidly follow the mnemonics, but we'll cover all the tests they represent.
Okay. And what if someone was born or died during the year? Can they still be a dependent?
Yes, good point. Even if a potential dependent was born during the year, maybe even on December 31st, or if they died during the year, perhaps on January 1st, they can still qualify as your dependent if all the other criteria were met for the portion of the year they were alive.
All right, so let's dive into the first category. Qualifying child, often abbreviated QC. You said there are 5 tests.
Yes, 5 distinct tests must all be met. These are the criteria your child, stepchild, maybe even a sibling or grandchild, needs to meet to potentially provide you with significant tax benefits, like the
Hmm.
child tax credit, or allowing you to file as head of household.
Okay, test number one.
Test number one is the close relative test. The individual must be your son, daughter, stepson, stepdaughter.
Okay, direct kids.
Right. Or your brother, sister, stepbrother, stepsister.
Siblings too.
Yes. Or a descendant of any of these people. So, your grandchildren, nieces, or nephews also fit here. This also includes individuals legally adopted by you or those lawfully placed with you for legal adoption. And a foster child placed with you by an authorized agency or by court order is also treated as your child for this test.
So it's a pretty broad definition of child in the tax world.
It is, yes, covers many common family relationships.
Okay, what's test number two?
Test number two is the age limit test. Generally, a qualifying child must be younger than you, the taxpayer claiming them.
Makes sense.
And they must be under age 19 at the end of the tax year.
Under 19.
Or if they're a full-time student, that age limit extends to under age 24 at the end of the year.
Under 24 for full-time students. Okay.
And there's one more important exception. There is no age limit at all for individuals who are totally and permanently disabled at any time during the tax year.
Okay. Good to know for families with disabled children. Now, what counts as a full-time student?
For tax purposes, full-time means the student attends an educational institution for at least part of each of 5 calendar months during the taxable year. Doesn't have to be consecutive months.
So basically showing up for a semester or a good chunk of the school year.
Right. It's designed to cover typical academic schedules. And an educational institution generally means a school with regular faculty, curriculum, and an enrolled body of students in attendance.
Okay. So close relative age limit.
Yeah.
What's test number three?
Test number 3 covers residency and filing requirements. First, the child must have the same principal place of abode, their main home, as you, the taxpayer, for more than 1/2 of the tax year.
More than half the year living with you.
Yes, temporary absences like school, vacation, medical care generally count as time lived at home. Second part of this test. The child must be a citizen of the United States or a resident of the United States, Canada, or Mexico.
U.S., Canada, or Mexico resident citizenship. Got it.
Yep.
And the filing part.
The child cannot have filed a joint tax return for the year themselves. There's a small exception if they only filed jointly to claim a refund of withheld taxes and had no actual tax liability, but the general rule is a married child filing a joint return usually cannot be claimed as your dependent qualifying child.
Okay, that's 3 tests. What's number 4?
Number 4 is a really important one, especially because it's different from the other dependent category. For a qualifying child, we eliminate the gross income test.
Eliminated. What does that mean?
It means there is no specific income limit for a qualifying child. A qualifying child can earn income, potentially even a substantial amount, and still be claimed as your dependent as long as they meet all the other tests.
Wow. So my teenager who worked a summer job and maybe earned several $1,000s could still be my qualifying child.
Absolutely, provided they meet the close relative, age, residency, and the final support test. That income doesn't automatically disqualify them, which is a significant point that often surprises people.
Okay, that is surprising and important.
It is.
So what's the 5th and final test then?
The 5th test is the support test. For a qualifying child, the rule is that the child must not have contributed more than half of their own support for the year.
Okay, they can provide some of their support, just not more than half.
Exactly. The IRS is basically asking, are you, the taxpayer, providing the majority of this child's financial upkeep? Support here means the total cost of basic necessities: food, lodging, clothing, education, medical and dental care, recreation, transportation, things like that. It's the actual expenses incurred.
So you need to figure out what the child's total support cost was and then determine if they paid for more than half of it themselves.
Correct. And there are some nuances. For example, Social Security benefits received by the child and used for their support are considered support provided by the child. But funds they receive and save don't count towards support.
Okay. What about scholarships? If my kid gets a scholarship for college?
Good question. Scholarships received by a dependent who is a full-time student are generally not included in the total support calculation if the dependent is your son, daughter, stepson, or stepdaughter.
So scholarships don't count as the child supporting themselves. That's helpful for college kids.
Very helpful. But note, this exclusion generally does not apply if the qualifying child is, say, your sibling or a grandchild, only for your direct children or stepchildren.
Another specific rule.
Ah.
Okay. And what if there's a situation where maybe both parents could claim the child but don't? like in a divorce situation where rules aren't followed.
If parents are entitled to claim the child but don't, there's a tiebreaker rule. Generally, no one else, like a grandparent the child also lived with, can claim the child unless that other person's adjusted gross income, AGI, is higher than the AGI of the highest earning parent. It prevents multiple people from improperly claiming the same child.
Got it. So 5 tests for qualifying child. Close relative, age limit, residency filing, no gross income test, and the support test. Child didn't provide more than half. That's a lot, but a very useful category.
It is. It covers most typical child dependency situations.
Okay, but that raises the question. Beyond your own children or close young relatives, who else might you be able to claim? You mentioned the other category, qualifying relative.
Exactly. The qualifying relative, or QR rules, broaden the scope significantly. This allows you to potentially claim tax benefits for supporting other individuals, like maybe an elderly parent, an adult child who isn't a student, or even someone unrelated who lives with you, provided they meet a different set of tests. This opens up more financial optimization opportunities.
Okay, so different tests for qualifying relatives. How many this time?
There are 6 tests to consider here, using that support framework loosely.
6 tests. All right, let's go through them. First one.
First is the support test, but it's different from the QC test. For a qualifying relative, you must have applied more than one half, greater than 50% of the person's total support for the year.
Okay, so for QC, the child didn't provide more than half. For QR, you, the taxpayer, did provide more than half.
Precisely. You have to be covering the majority of their living expenses. The definition of support is the same: food, lodging, clothing, medical, etc. If you're footing more than half the bill for someone's upkeep, this is the first hurdle for claiming them as a QR.
Got it. More than 50% support provided by you. What's test number 2?
Test number 2 is the under gross income limitation. This is a critical one and very different from the QC rule. A person generally cannot be claimed as a qualifying relative unless their gross income for the year is less than a specific amount. For 2023, that amount was $4,700. It adjusts slightly for inflation each year.
Wow, less than $4,700 in gross income. That's a pretty low limit.
It is a hard income limit, yes, and it catches many people by surprise. It means many adults you might support, if they have even a modest amount of taxable income, won't qualify as your dependent relative.
Okay, but you emphasized gross income. Does that include everything they receive?
No, and this is vital. For this specific limitation, only income that is taxable is included.
So non-taxable income doesn't count towards that $4,700 limit.
Correct. This is a common area of confusion, but a very important rule. Certain non-taxable income sources, like Social Security benefits, especially if that's their only income, as often only a portion or none is taxable, or tax-exempt interest income from state or municipal bonds or tax-exempt scholarships, these are not included when checking if someone is under that gross income limit.
So someone could receive, say, $15,000 in Social Security benefits, but if none of it is considered taxable income for them, based on other factors, they could still be under the $4,700 gross taxable income limit and potentially qualify as your dependent relative.
Exactly. That's a perfect example of why understanding what counts is so crucial here.
Okay, that's huge.
Yeah.
So, support test, you pay 50%. Under gross income limit, they earn $4,700 taxable. Test number 3.
Test number 3 is precludes dependent filing a joint return. Similar to the QC rule, a person generally does not meet the definition of a qualifying relative if they are married and file a joint tax return for the year. Again, there's that exception if they only filed jointly for a refund and had no tax liability. But generally, married dependents filing jointly can't be claimed.
Okay, consistent with the other rule. Test 4.
Fourth, the individual must be only citizens of the United States or residents of the United States, Mexico, or Canada. Same geographic limitation as for qualifying children.
Got it. Citizenship residency. Test 5.
Test 5 is the relative test. This is where we define who counts as a relative for this purpose. It's a broad category. Includes your children, grandchildren, parents, grandparents, brothers, sisters.
I would get the obvious ones.
Aunts and uncles, nieces and nephews. It also explicitly includes stepchildren, stepparents, stepbrothers, or stepsisters, and certain in-laws, like your mother-in-law, father-in-law, brother-in-law, sister-in-law.
So a pretty wide family circle. Who is not considered a relative here?
It's worth noting that cousins and foster parents are not considered to be relatives under the specific definition for the qualifying relative test, which leads us directly into the final test.
Okay, test number 6. This applies if they aren't on that relative list.
Exactly. Test 6 applies if the individual is a non-relative, according to that list. In this case, the rule is the taxpayer must live with the individual for the whole year.
The whole year, not just more than half.
Correct. A non-relative member of your household, like a cousin, a foster parent who didn't meet the QC definition, or even just a friend you're supporting, can potentially be considered your qualifying relative only if they live in your home as their principal place of abode for the entire year and your relationship doesn't violate local law.
So relatives on the list don't necessarily have to live with you, like parents, as we saw for HOH2, but non-relatives absolutely must live with you all year long.
That's the crucial distinction. It really shows how granular these IRS rules can get.
No kidding. And remember that little pass key about birth or death during the year applies here too.
Yes. A person born or who died at any time during the year can still meet the relative test or the live with you all year test for the portion of the year they were alive, provided all other relevant QR tests, support, gross income, etc., are met.
Okay, so 6 tests for qualifying relative. Support, 50% from you. Under gross income, $4,700 taxable. No joint return. Citizen, resident, relative or non-relative living with you all year.
That covers it. The key takeaway for both QC and QR is the meticulous detail required for each test. Every single condition must be satisfied to properly claim the tax benefits. It makes careful review of each individual's specific situation absolutely essential for maximizing your financial optimization.
Okay, that makes sense. Now, what about tricky situations? What happens if multiple people say siblings are all contributing to support someone, like an elderly parent, but no single person provides more than half the support? Does anyone get to claim them?
Ah, yes. That scenario comes up more often than you'd think, especially with rising costs for elder care or supporting other relatives. Luckily, the tax code addresses this with something called a multiple support agreement.
Multiple support agreement.
Yeah.
Okay, how does that work?
It's a practical solution for exactly that situation, where two or more taxpayers together contribute more than 50% of a person's support, but no one of them individually contributes more than 50%.
So if dad's care costs $20,000 and son A pays $9,000, 45%, son B pays $8,000, 40%, and daughter C pays $3,000, 15%. Together, they pay 100%, but nobody hit 50%.
Perfect example. In such cases, the contributing taxpayers, all of whom must meet the other requirements to claim the person as a qualifying relative, except for the 50% support test, or have lived the entire year with them if unrelated can agree among themselves which one contributor may claim the individual as a dependent for the tax benefits.
So they can choose who gets the tax break.
Yes, they can designate one person. It prevents everyone from missing out just because no single person crossed that 50% support threshold individually.
Are there conditions on who they can choose?
Yes, a couple of important ones. The person designated to claim the dependent must have contributed more than 10% of the person's total support.
Ah, so in my example, daughter C, who paid 15%, could potentially be chosen. But someone who only chipped in 5% would be out of the running.
Exactly. You need to have provided a meaningful portion of the support, defined as over 10%. And of course, that chosen person must also meet all the other dependency tests for a qualifying relative, like the gross income limit, relationship or residency test, etc., just not the 50% support test.
Okay, and how do they formalize this agreement? Do they just pinky swear?
No, the IRS wants it documented. The person claiming the dependent under a multiple support agreement must file Form 2120, Multiple Support Declaration. This form is signed by each other, person who contributed more than 10% of the support, stating that they agree not to claim the individual as a dependent for that year.
So it's a signed agreement filed with a tax return. Makes sense.
Let's walk through that. Example 1. Multiple support agreement from the source material to make this really concrete. Imagine Peter, who is single and lives alone in Idaho. He has no income of his own. His total support for the year costs $5,000.
Okay, Peter, no income, needs $5 support. Who helped him?
Here's who contributed. Tim, an unrelated friend, contributed $2,400. That's 48% of Peter's total support. Angie, Peter's sister, contributed $2,150. That's 43%. Mike, Peter's son, contributed $450. That's only 9%.
Okay, so Tim, 48% plus Angie, 43% plus Mike, 9%, includes 100%. Together, Tim and Angie clearly provided more than 50%, but neither hit 50% alone. This is a perfect multiple support agreement situation. The question is who can claim Peter?
Right. We need to test each contributor against the qualifying relative rules, keeping the multiple support agreement modifications 10% support instead of 50% in mind. Let's start with Tim, the unrelated friend.
Okay, Tim. Support test. Did he provide 10%? Yes, 48% is way over 10%.
Mhm.
Under gross income test. Does Peter have $4,700 taxable income? Yes, Peter has zero income. Check. Preclude joint filing. Is Peter filing jointly? No, he's single. Check. Only U.S. citizens residence. Is Peter one? Yes, lives in Idaho. Check. Now the tricky one. Relative OR lived with taxpayer all year.
This is where Tim fails. He's an unrelated friend, so he's not a relative on the list. And Peter lives alone, so Tim did not live with Peter for the entire year.
So even though Tim provided the most support, 48%, he fails this crucial test. He cannot claim Peter, even with an agreement.
Correct. It doesn't matter how much he contributed if the relationship or residency criteria aren't met for a qualifying relative. Okay, next. Angie, Peter's sister.
All right, Angie, support test. Did she provide 10%? Yes, 43% is well over 10%.
Yeah.
Check. Under gross income. Peter still has no income. Check. Preclude joint filing. Peter is still single. Check. Only U.S. citizens residence. Still, yes. Check. Only U.S. citizens residence. Relative OR lived with. Is a sister a qualifying relative?
Yes, a sister is definitely on the list of qualifying relatives. Because she is a qualifying relative, she is not required to live with Peter.
So Angie passes this test. She meets all the dependency definition requirements for Peter, just substituting the 10% support for the 50% rule under the multiple support agreement context.
Exactly. Angie is a potential candidate. She's in the running to claim Peter. Now let's check Mike, Peter's son.
Okay, Mike. Support test. Did he provide 10%? No, Mike only contributed $450, which is 9%.
Stop right there. Since Mike didn't contribute more than 10% of Peter's support, he is not eligible to claim Peter under a multiple support agreement, even though Peter is his father, a qualifying relative.
So Mike is out. Tim is out because he's not a relative and didn't live with Peter. Angie's the only one left who meets all the criteria, including the 10% support.
Correct. This example clearly illustrates the detailed analysis required. It's not just about who paid the most, but about meeting all the tests, relationship, residency, income limits, and the specific support thresholds for the situation. In this case, only Angie could claim Peter as a dependent, provided she files Form 2120 signed by Tim, the other person who contributed 10%, stating he won't claim Peter.
That really shows how precise you need to be. Great example of using the rules for financial optimization within a family.
It is. It ensures someone gets the tax benefit when support is shared.
Okay, one last tricky dependent area.
Yeah.
Children of divorced parents. This sounds like it could be a common point of confusion or even arguments. Who gets to claim the child for tax purposes after a divorce?
Yes, this can often be a point of considerable confusion and sometimes contention. The rules here are quite specific, and importantly, they often override whatever might be stated in a divorce decree or child custody agreement regarding taxes.
Really? The IRS rules trump the divorce decree?
Generally, yes, when it comes to determining who can claim the child based on residency. The general rule is that the custodial parent gets to claim the child as a dependent for tax benefit purposes.
And who is the custodial parent? Is it whoever the decree says has custody?
Not necessarily. For tax purposes, the custodial parent is the parent with whom the child lived for the greater number of nights during the year. It's a physical custody time test based on where the child actually slept.
So it's literally counting nights.
Essentially, yes. The parent the child spent more nights with is generally considered the custodial parent for tax purposes, regardless of what the divorce decree might say about who gets to claim the exemption or credit. It also doesn't matter whether that custodial parent actually provided more than one half of the child's financial support. The primary factor is physical custody time.
So even if my divorce papers explicitly state that my ex-spouse gets to claim our child every year, if the child actually lived with me for more nights, say 183 nights or more, then I am generally the custodial parent for tax purposes and the one entitled to claim the dependency benefits.
That's usually how it works under the general rule, yes. This often surprises people, but the IRS prioritizes the actual living arrangements over potentially outdated or non-compliant legal agreements when determining who gets the primary claim based on custody. Now, the custodial parent can release the claim to the non-custodial parent using Form 8332, but the starting point is the custodial parent having the right.
Okay, what if custody is split exactly 50-50? Maybe the child spent exactly 182.5 nights with each parent, or it's a leap year.
Right. If the parents have truly equal custody time during the year, there's a tiebreaker rule. In that specific situation, the parent with the higher adjusted gross income, AGI, for the year gets to claim the tax benefits related to the dependent child.
Higher AGI wins in a tie.
Got it. Understanding these rules is just critical. As we've discussed, claiming a dependent child can significantly impact a parent's ability to claim advantageous filing statuses like head of household or crucial tax credits like the child tax credit. These are significant financial optimization strategies for families.
And ignoring these rules could lead to problems, right? Like both parents trying to claim the same child.
Exactly. If both parents claim the same child improperly, it's a red flag for the IRS, almost guaranteed to trigger notices, potentially audits, and require one parent to amend their return and possibly pay back taxes plus penalties and interest. Following the rules avoids that headache.
Wow. Okay. So custodial parent based on nights, unless they release the claim, and higher AGI wins ties. Crucial stuff for divorced or separated parents.
Absolutely essential to get right.
Wow. We have covered a ton of ground today. We've just taken a truly comprehensive deep dive into the building blocks of individual income tax, from understanding that core formula that dictates your tax journey.
Gross income down to tax due or refund.
Right, to dissecting every filing status, the nuances of dependence with cares and support, who needs to file, when the deadlines are. It's a lot to absorb, but honestly, each piece feels like a potential lever for your financial well-being.
It really does. And if we connect all this back to the bigger picture, it becomes abundantly clear that these aren't just dry, boring rules hidden away in some tax code. They are the essential levers you can pull.
Yeah.
Levers to accurately report your income, yes, but also to maximize your eligible deductions and credits, and ultimately to ensure you're not paying a single dollar more in tax than you absolutely need to. This knowledge truly is your pathway to being more financially well-informed.
Allowing you to actively identify those opportunities for financial optimization.
Exactly, and keeping more of your hard-earned money. It empowers you to proactively engage with your financial situation, transforming what might feel complex into real clarity.
So, as you, our listener, reflect on today's deep dive, maybe consider this. How might a closer look at your own income sources or your current family structure, maybe even just your regular expenses like medical or charitable giving? How might that reveal new opportunities to apply these tax fundamentals to your advantage next tax season? It's not just about April 15th, is it? It's about year-round awareness.
That's such a great point. And remember, understanding these core principles isn't just about filing a return once a year. It's really about making informed financial decisions throughout the year that cumulatively impact your tax situation. So maybe ask yourself, what one detail from today's discussion, maybe about HSAs or the head of household rules or tracking itemized deductions or understanding community property, what one detail will inspire you to look at your own finances differently, perhaps prompting you to track a new deduction, reconsider your filing status, or even make that contribution to an IRA or HSA before the deadline? The journey to financial empowerment really begins with these insights.